Oops. Morning, everybody. Didn't realize it was off. Welcome to Chapter 8, so-called the firm cost and output determination. So in Chapter 8, we look at this distinction between accounting profits and economic profits. And then we look at this, the short-run production function and how it's related to diminishing marginal returns. And then we look at this whole set of costs that we use. So we look at variable costs and fixed costs and total costs. And then we calculate all those costs on an average cost per unit basis. So average variable cost, average fixed costs, average total costs. And then we calculate marginal cost. And I was going to mention that when it comes to marginal costs, we calculate marginal costs from total costs, and we do not need to know what the average costs are in order to calculate marginal costs. And the marginal cost curve we'll see later on. Later on, but the marginal cost curve is simply another name for the supply curve. So we know that in equilibrium. Equilibrium price and quantity are set by the intersection of the supply and demand curves. So the marginal cost curve is the supply curve. But we'll come to that. Okay. What else do we look at in Chapter 8 here? Oops, better get rid of that. We look at some relationships between these various cost curves. We're going to see how the marginal cost curve intersects the average variable cost curve and the average total cost curve at the minimum point of those curves. Anyways, we'll come to that, and then we look at the long run cost curve. So before we jump right into Chapter 8 here, I thought I would give you a bit of background to this distinction between economic profits and accounting profits, and try to explain to you why economists view profits as a cost rather than simply a residual the way accountants do. Okay, so as we know from this course and business math and marketing and whatnot, we know that accountants view profits as a residual. It's the balance that's left over from revenues after all expenses have been paid. And as we see in economics class, in math class, and marketing class, we can classify these accounting expenses into fixed costs, or variable costs, or fixed costs. And I should mention to you before I forget that another name for fixed cost is overhead. Okay, so when economists look at costs, they look at them from a slightly broader perspective than accountants. And I want to show you this because there's a good chance you didn't pick this up way back in Chapter 2. So way back in Chapter 2 on page on page 44, there's a small diagram that's a model of the macroeconomy, or it's a macroeconomic model of the economy. And the little diagram that we see in the bottom of page 44, I've tried to replicate it myself on the screen here, but we'll come back to this diagram and many variations on this diagram in the course in macroeconomics next term for most of you. So in this diagram on page 144, and on the diagram I have on the screen, what we basically have is on the right-hand side, we have so-called households, and on the left-hand side, we have businesses, or as economists like to call them, firms. So there's a relationship between households and firms in the economy. Households sell inputs to businesses, and businesses transform those inputs into products that they in turn sell to households. And of course, when the households buy products produced by businesses, that's goods and services, when it buys these outputs, Of course, the households have to pay for those purchases, and so the households send money to businesses. But likewise, when the businesses buy these inputs, otherwise known as factors of production or resources, inputs, whatever you want to call them, likewise, when the households sell these factors of production to businesses, businesses in turn have to pay the households for the use of those inputs. And you can see in the little diagram here that I have four classes of inputs: land, labor, capital, and risk-taking, or the book calls it entrepreneurialism. It's just another name for the same thing. This is a good reason why I write messily, so I don't have to spell properly. But so we have these, in classical economics, we have these four classes of factors of production. We have land, labor, capital, and risk-taking. And in classical economics, we have a return corresponding to each one of those factors. And each one of these returns, each one of these payments has a special name. And these are special names, and we'll come back to them in macro. So the return for the use of land is known as rent. The return for the use of labor is known as wages. The return for the use of capital is known as interest. And the return for the input of risk-taking or entrepreneurialism is called profit. These are sort of technical classical economic terms, and we'll come back to them in macro. Anyways, the point is when businesses make use of these inputs from households, it has to pay for each one of these inputs. And one of the inputs is called entrepreneurial scale or risk-taking, and there's a payment for it. And so risk-taking is a factor of production just the same way that machinery is, just the same way that our time is that we sell to our employers, and just the same way as land that buildings are built on. Each one of these are factors of production. And so economists see this payment for the use of entrepreneurial skill to be a payment to a factor of production, just the way these other payments are for the other factors of production. Anyways, so economists see that these payments for these factors of production, they're all costs rather than profit simply being a residual. Okay, so economists view profits as a return to the factor of production of entrepreneurial skill. So I've tried to illustrate this again in this little diagram on the screen. So let's say we have a business and they generate $1,000 in revenue. So that's the blue area. Here's $1,000, here's zero. And when accountants take a look at the numbers, they say, okay, we've got all these production costs, so we have some costs, or we have some variable costs, and we also have some fixed costs, otherwise known as overhead. And the difference between cost and revenue is accounting profit. And then economists get a hold of the same figures, and they say, hey, we don't disagree with accountants. We simply look at the numbers from a different perspective, and we see the businesses making payments to these factors of production. So we have these four factors of production. Businesses have to pay for them: land, labor, capital, and risk-taking. And the businesses have to pay a return to those input owners, and so landowners receive rent, labor suppliers receive wages, capital suppliers receive interest, and risk-taking suppliers receive profit. So economists where's my little thing here, divide profit into two portions. We have the normal portion, and we have the normal profit portion, and we have the economic profit portion. So when a business generates profits, if the level of profit is in excess of the normal amount, then that excess amount is known as economic profit. And so that kind of leads us back to the slides from the chapter. Okay, and then I was just going to also mention that economists also factor in so-called opportunity costs. So when businesses use these factors of production, they have to pay a price for them. They have to pay the owners of those inputs a return, and generally they have to pay the market. They have to pay the market price. But if the business ever pays a quote-unquote sub market price, then economists count the difference between the market price and the sub-market price as an opportunity cost. And economists include that opportunity cost in its calculation of economic profit. So that's another difference between the way accountants do things and the way economists do things. Okay, so now let's go back to the slides, and we'll just kind of continue on here. Okay. Oops. Okay, so we draw this distinction between explicit and implicit costs. So implicit costs are the costs that are measured by accountants. These are also known as out of pocket expenses. So these are the expenses that businesses actually write checks for, in that they count on their income statement. And then we also have implicit costs, and implicit costs are measured by economists rather than accountants. And our classic example of an implicit cost is an opportunity cost. And an opportunity cost is a non out of pocket expense. So the business does not write a check for payment for an opportunity cost. And so an example of an opportunity cost is, let's say we have a business and we have some people that have invested in a business, and the business provides a return of 5%. And let's say those investors are also familiar with another investment opportunity that promises a payment of 12%. So if the investors keep their investment in option A here rather than B, if the investors keep their investment in option A, then they suffer an opportunity cost loss of 7%, which is simply the difference between 12 and 5. So the opportunity cost, economists would count this foregone improvement in return for staying with the default investment rather than switching over to the better returning investment. Okay. So we have the accountants. We have the accountant's formula for profit. So as we mentioned before, for accountants, profits equal revenues minus all the explicit costs, and so profits are really a residual. It's a residual calculation. Okay. Oops, better clear that. Oops. Okay, so again, when businesses look to attract investment capital, they have to offer a return to prospective investors. And this return, this so-called normal rate of return, it's the rate of return that businesses have to offer investors to invest in the business, because businesses can't expect investors to invest without the business offering a competitive rate of return. And now we have this concept of opportunity cost of capital, and this is the economic concept. So the opportunity cost of capital is the foregone difference in yield, or the foregone difference in return from not investing in the next best opportunity. So it's the amount of income or yield that could have been earned by investing in the next best opportunity. So I have a few examples here to kind of illustrate how this works, because it is an area that it is easy to be confused about. So I just want to try to illustrate this to you. So just a second here. Okay. Okay, so first example. So let's say you have $1,000 in your pocket, and you're walking down the street and you see a sign at your local bank that says, hey, Bank A is offering 2% interest on a savings account. So if you decide to leave your funds in your pocket, rather than investing in this savings account at Bank A here, your opportunity cost of capital is 2%. You're foregoing that 2% in favor of leaving money in your pocket. Therefore, economists say that you suffer an opportunity cost. Okay, so next little example here. Oops, sorry. Okay, so now let's say you go ahead and invest $1,000 in the savings account at Bank A, and you're earning 2%. And then as you walk down the street a little bit further, you see Bank B offering interest of 3% on their savings account. If you decide to leave your $1,000 at Bank A rather than switching to Bank B, then your opportunity cost is now 1%, because you're foregoing this difference between the 3% offered by Bank B and the 2% that you're receiving at Bank A. You're suffering a loss there of 1%. So you're suffering an opportunity cost of capital of 1%. Okay, then I have one third little example here. Okay, so now let's assume you have $1,000 in your pocket, and you're walking up the street, you're walking in the opposite direction as before, and you see that Bank B is offering 3% on its savings account. If you leave this $1,000 in your pocket, rather than investing in Bank B, your opportunity cost is 3%. Why? Because the concept of opportunity cost is relative. It's relative to your default choice. So if the choice is between leaving the money in your pocket and not earning anything versus investing in the 3%, then your opportunity cost is 3%. If the bank is only offering 2% and you leave your money in your pocket, then your cost is 2%. If you invest in Bank A and receive the 2%, and then you find out about Bank B offering 3%, but you decide to stay at Bank A instead, then your opportunity cost is only 1%. So opportunity cost is the foregone incremental return or yield from not investing in the next best option, measured with respect to your default choice, which is simply, in this case, leaving the money in your pocket. Okay, so let's just move on. Okay. Oops. I have this new little pen, and I'm still not quite used to using it. Okay, so we know that accounting profit is simply a residual. It's revenues minus all expenses equals net income, otherwise known as profit. So we saw earlier that economists define the concept of economic profit a little bit differently. So remember, we have we have profit, profit, and we have, oops, profit, and we have two portions. We have the normal portion, which is the industry standard return, and then we have the economic profit portion. If there in fact is an economic profit, there's not always an economic profit. So one way of defining economic profit, it's the difference between total revenues and all explicit and implicit costs. So explicit, these are the accounting costs, and implicit costs are any opportunity cost. So if the business is not paying fair market price for any of the inputs, it's the owner of those inputs is suffering an opportunity cost, and so economists factor in that opportunity cost when they calculate economic profit. So another version of the definition of economic profit is the difference between total revenues and the opportunity cost of all factors of production. So why is this so? Every factor of production, so remember in classical economics we have four factors of production, I call it FOP. We have land, labor, capital, and entrepreneurialism or risk-taking. Each one of these factors of production has an economic return. It's called rent, wages, interest. I don't like the word. Interest and profit. So every factor of production has a return. So if any factor of production does not receive its fair market payment, then that factor of production suffers the owner of that factor of production suffers an opportunity cost. And so when economists calculate economic profit, they have to factor in all these implicit costs. So it has to include all of the opportunity costs associated with the factors of production. So if the opportunity cost of the investment in each factor of production, if the opportunity cost for each factor of production equals its explicit cost, so the cost that's paid by accountants, then economic and accounting profits are identical. But if the opportunity cost of the investment in the factor of production is greater than the explicit cost, then then economic profit equals accounting profit minus the additional opportunity cost for that factor of production. So the book kind of points out here, if you have an entrepreneur and they're running a business and the business wants to calculate its economic profit, it has to factor in all the opportunity costs associated with the factors of production that it uses. So sometimes, when people start businesses, people don't pay themselves what they would receive if they were working someplace else. So when economists calculate the economic profit for that business, they do factor in the opportunity cost of the lost wages of that person. If the person could earn more money elsewhere, economists factor in that cost. And likewise, if the person invests money in the business and it doesn't generate as much return as it could earn elsewhere, then economists will factor in that opportunity cost in calculating economic profit. Okay. Oops, sorry. Oh my goodness. This new little mouse, this new little pen that I have doesn't work quite the same as my regular pen. Okay, so we have this opportunity cost of capital. So it's the foregone difference in yield or return from not investing in the next best option. So if you have some uninvested funds, so if you have money in your pocket, money under your under your mattress, the opportunity cost of capital is the normal rate of return. So the normal rate of return is the industry standard return that you could obtain from investing in another business. And as we mentioned before, economists view the normal rate of return as a return to the factor of production of risk-taking, and thus when we calculate economic profit, we have to factor in the normal rate of return as the estimated cost of that factor of production, which is risk-taking. Okay. So here's our formulas once again for economic profit. So we have two versions of the formula. Economic profits equals total revenues minus the opportunity cost of all inputs. Alternatively, we can define it as economic profits as total revenues minus all costs, whether they're implicit or explicit. And there's even a third version. It's economic profits equals accounting profits minus opportunity costs, minus implicit costs. Okay, so to finish up this section, we have a bit of a illustration. We have a bit of an illustration, sort of a graphical illustration of the difference between economic and accounting profits. So here we have total revenues, this amount here. So here the accounting, here we have the accountants over here, and here we have economists over here. So accountants see these explicit costs, and these are variable costs plus our fixed costs, otherwise known as overhead. Subtract our explicit costs from our total revenues. That's going to equal our accounting profit. When economists calculate economic profit, they attribute a normal rate of return to the factor of production of risk-taking or entrepreneurialism, and if that normal rate of return is identical to the accounting profit, then there are no economic profits. If the normal rate of return is less than, normal rate of return is less than the accounting profit, then we have positive economic profits. And if the normal rate of return is greater than the accounting profit, then we have negative economic profits. So I have some more examples. I have 4 little examples here just to kind of illustrate this to you. So let's see if I can find that. Let's see if I can find that. So I just have to look for it here. Oh, there we go. There we go. So this is not as large as we might wish, but anyways, what the heck. Okay, so in our base scenario, we have a business that has revenues of $1,000 per year. So that's the blue line here. There's 0, there's 1,000. In our base case here, we have the accounting perspective. So we have accounting costs of $800, and we have accounting profit of $200. That's that amount here. There's 800. And in this industry, the normal profit is $200. So the way I work this out is I'm saying in this business there's $4,000 invested, and the accounting return is $200. So the accounting return is 5%. So that's 200 divided by 4,000 times 100. That's 5%. Okay, so now let's move on to our next little example. So that's our base case. That's our base case. Come on. Okay, so now, this is kind of a repeat. Anyway, so here's our base case. So we're saying that in this particular industry, the normal rate of return is 5% per year. So we have accounting revenue of $1,000, same as before. Accounting cost of $800, same as before. Accounting profit of $200, same as before. And the accounting return is 5%. $200 divided by 4,000 times 100 is 5%. So if the normal rate of return in this industry is also 5%, then economists are going to count this 5% as the return to risk-taking, or entrepreneurialism, whatever you want to call it. And so economists see that 5% return, that $200, they see that as a cost. And so from the perspective of economists, there's no economic return from investing in this business. That 5%, that $200, economists say that's an expense that gets returned to the entrepreneur. And so that's the opportunity cost that has to be included in the calculation of economic profit. Therefore, there's no economic return. There's no economic return. And okay. So now let's look at our next scenario here. Okay, so now we're going to say that in this particular industry, the normal rate of return is only 4%. In the last scenario, it was 5%. Now it's only 4%. So again, we have a business that's generating $1,000 in revenue per year. Its accounting costs are $800, same as before. The accounting profit is $200 per year, same as before. But now we're saying in this industry, so the accounting return is still 5%. $200 divided by the $4,000 investment times 100 equals 5%. But now we're saying that the industry standard return in this particular industry is only 4%. So 4% ends up being a return of only $160. That's 4% times $4,000 investment equals 160. So this business is still generating $200 in accounting profit, but only 160 of it is the normal profit. And so the difference between the total accounting profit and this normal rate of return in the industry is $40. So that $40 is the economic profit. So economists say this business is generating an economic return of $40, or in return terms, it's 1%. So that's the $40 divided by the $4,000 investment times 100 equals 1%. So we have a positive economic profit in this example. Okay, in the next example, we're going to do an example of an economic loss. Oops. Okay, there we go. So in this example, so again, so in this case, we're going to say that the normal rate of return. Oh, don't like red. The normal rate of return in this industry is 6%. Our base case was 5%. Now we're going to say it's 6. So again, we have a business that's generating $1,000 in revenue, same as before. Has $800 in accounting costs, same as before. Has an accounting profit of $200, same as before. But now we're saying that the normal rate of return in this industry is 6%. So if we multiply our investment in the investment in the business times 6%, we're going to get $240 per year. So the normal profit in this industry is $240, but our business is only generating $200. And so that tells us that we have an economic loss of $40. And so although the accounting return is still 5%, that's the $200 divided by $4,000 investment times 100 is 5%. The economic return, which equals the accounting profit minus the normal return, so $200 is the accounting profit, minus normal return of $240, leaves us with an economic, it's a negative economic profit, which is an economic loss of $40. And so this business is suffering an economic loss of 1%, which is $40 loss divided by the $4,000 investment times 100 is 1%. Okay, so I have one final example, and then we'll finish off this first section. I have one final example. So in all these scenarios that we've looked at so far, we've presumed that the business has been paying the market price for all the factors of production: land, labor, capital, and entrepreneurialism. It's paying the market price. So what happens if the business pays a sub-market price for some of these inputs? So let's go back to our default scenario where the normal rate of return is 5%. So we have a business generating $1,000 in revenue, accounting cost of $800, accounting profit of $200, same as before. Oops, I think I got this mixed up. Oh, sorry. I do have a little mistake here. That should say 0, 0, 0, 0. That's a correction there. Anyways, so what do we have? So the normal rate of return is 5%, and in this case, our economic profit is minus. So in this case, the business is buying a factor of production at $100 less than the market price. So the business is effectively being subsidized to the tune of $100. So we have to factor in that opportunity cost for that factor of production. And when we factor in that opportunity cost, that creates an economic loss of $100. So our accounting return is $200. Our economic return is originally 0, but then we find out that they've been underpaying for one of the factors of production by $100. So the entrepreneur is not getting paid what he would normally get paid. So instead of, the entrepreneur, he's a skilled fellow, he can normally earn wages of $30 an hour, but when he works for his own business, he's only paying himself $20 an hour, and so he's foregoing $10 per hour there, so he's incurring an opportunity cost of $10. So when we factor in that opportunity cost, the economic profits are minus 100. It's minus 100. And so we factor in the additional costs of the economic profits. The economic profits are negative 100. So our return, even though the economic return is still 5%, because the accountants say he's still making $200 on a $4,000 investment, so he's still making accounting profits of 5%. But when we factor in the $100 loss, the opportunity cost, he's losing $100, and so the economic return is minus 2.5%. So it's minus 100 divided by 4,000 times 100 equals minus 2.5%. Okay, so that's those are my final examples for this first section of chapter 8, and now we're going to go to the second section of the chapter, but I'm going to create a separate video for that. Talk to you later.